But that makes sense if you think about it, because all these accounts that we're talking about were set up to be integrated with the tax laws. Registered retirement savings accounts, RIFs, tax-free savings accounts, registered investment accounts, they're all about tax, or education plans are all about taxes. And of course, the RIFs that you're going to experience once you have your RSPs mature is also all about taxes, right? It's a way to make you move it from your RSP into something that they can force taxes upon you again. A RIF is nothing more than an RSP that has a requirement to pay out a certain amount each year, and it's so that they can get their refunds back. They gave you a refund years ago, and they want their money back, right? And so they force that situation upon you.
May I ask you, do you have the novels in your site?
Yes. Yes.
Something I do give you for sure.
Well, I'm selective. Throughout my career, I do not put money in my RSP unless I'm at a high tax bracket. Because if I'm going to, the hope is that if I'm going to make a deposit this year and receive a refund of 46% of what I put in, there is hope that sometime in the future, when I make the withdrawal, I hopefully have arranged my affairs well enough that I'm at a tax rate lower than 46%. So it can't get worse. I'm already at the highest possible tax bracket. So there's a hope that I'll be out of the lower tax bracket. But if I'm already at the lowest tax bracket, what's my hope? That I'm at a higher tax bracket when I take it out, right? So the people that are at very high tax rates, RSPs are okay. And they're probably not going to be harmful. Because even if I put it in the RSP and got my 46% refund and then died tomorrow, the worst case is I'd have to give it back at the same rate as I received my refund. So it wouldn't have harmed me. I might not have gained any advantage, but it wasn't harmful. If you're at any rate below the top rate, you have to be concerned about how much harm it can do to you.
Is it 86 now? To be at the 40?
Actually, it's all the way up to 125, but you're pretty close to that at about 86,000. So, I mean, we talk about the breaks as being just roughly, 38, 75, and 125. But there's so many little surcharges put on by the province. See, a few years ago, the province of Ontario started calculating their taxes independent of the taxes in the federal government. So you still put it on one tax return, but there's actually two taxes you're paying in that tax return. And they have different rules, and they have different levels. And so there's actually many marginal breaks now. There used to be about 3. And now there is many breaks along the way. When you run out of if you're over 65 and you start running out of your AIDS deduction, that's an increase in your taxes. If you go over the limit for when you start paying back your old age security, that's, in my mind, just like an additional tax. It has the same effect as an additional tax. So there's all kinds of these brackets now. Basically 38, 75, and 125. But if you're at the 125 range, or even at over 85, you're probably not going to be harmed by an RSP. If you're down at $40,000, you're probably good chance you'll take it on the nose. So you'd be a little bit more cautious and think about your affairs a little bit more carefully. That's all. And certainly we have lots of clients that might make $50,000, $60,000 a year that are using RSPs. But we're more careful with them. We're always trying to think, well, is this going to be a good idea for that particular person? Because for one person it will be a good idea, for somebody else it will not be. So, and I think, and I was trying to hit on this in the article, I think there's a lot of people in Canada that actually their tax bracket won't change. Yeah, if you think about the people that are, have good pension plans and things like that, with any luck, they're just pushing up against the edge of that higher tax bracket, and when they retire, 60 or 70% of that number will still be in the same range of taxes. So they're probably not going to experience much lower tax break or a change in the marginal tax rate in the future. So they're exposing themselves to a potential loss, and the government's going to win. Okay? And so we try to limit the government's win. Think of it that way. So, you know, and that's true of many things that we plan for clients. One of the strategies that's been around for years for people that have more than enough money that they need to retire on, for example, and they know they're going to leave an estate to their children or somebody. The question that we always ask, well, if we know that you're not going to spend all the money you have because you've built up more wealth than you actually require, then obviously insurance strategies are possible. But the reality is, the reason the insurance strategy works is because you're literally going over and making a deal with an insurance company and saying, you know, why do the two of us work together to make sure Revenue Canada loses, right? And since I need you, insurance company, I'll let you make a little bit of money too. But so instead of paying them $20,000, I'll pay you 10 and I'll get to keep 10. So you're just cutting a deal with an insurance company to disadvantage Revenue Canada. And so many tax, the way you organize your affairs, tax avoidance. I was looking for the right word. Tax avoidance is about just disadvantaging Revenue Canada so that somebody gets to keep more than they do. And there's not that many ways to do it in Canada, unfortunately, for a lot of people. And that's why the RSPs were so popular, because they were sold as the one thing that you could do to disadvantage Revenue Canada and you come out as a winner. They painted a little bit too broadly, though, with too big of a brush. And that's the major shortcoming with the RSPs. They're not that good for everybody. And even before the introduction of tax-free savings accounts, we were advising clients not to use RSPs if they weren't making more than about $38,000 a year. Except in well, I shouldn't say everybody, but in a lot of cases. And very often when they put it in, when they were earning that, we told them, don't take the deduction yet. Wait until you're making more, and then their refund will be worth more. So we were always kind of keeping our eye on the fact that they got to maximize that refund they're getting, or it may turn bad against them. And now with the tax-free savings accounts, it's not even a question. If you make less than $38,000 a year and you've got some savings, don't put it in the RSP, put it in the tax-free savings account. And if you've got people that need to go to school, put it in the RESP before you consider even those two things. So the tax-free savings account, in my mind, gave us clarity on those people that make less than $38,000 a year. So, but we were always pretty sure that we shouldn't do it.
What about I think they're called ETFs?
Yeah, investments inside the,
Stock market?
yeah, we're going to start with
Exchange
that.
traded.
So have we, I want to make sure that we get all the questions out. You had some about RIFs.
Yeah, a lot of us have RSPs. And for me, I'm approaching 70, not my wife.
Good recovery.
But you know, that date's going to come along. They're 71 years old. Well, what do? You buy an annuity. You know, what do you do? You have to fold those RSPs, fold them in.
Yeah.
Or
Okay.
you take the money out and you're crucified. You know, to me, you'd have to buy an annuity. That's the only way